In this section, we're going to discuss about a company's valuation model and not necessarily the end stage of valuation, but how do you actually build about a completely interlinked model such that the data flows through the model in a very, very dynamic manner and you have all the linkages working correctly such that you end with a fully balanced balance sheet as well. Now, this is only going to be relevant if you are making future forecasts, right? Because historical numbers are anyway available. And if you're looking at, let's say, the history, in history, the model will be in such a way that the balance sheet will be balanced. That's because these are historical numbers, right? It's only when you make projections is that you have to balance the balance sheet, right? So that is what we are trying to do, wherein we will pick up the model of Maruti Suzuki. There are some data points that are already put in here, and at this stage, we are not concerned about how do we go about building the entire thing. What is more relevant for us is that once we have built in a certain set of data points there in this model, how do we manage this model or maintain this model such that the linkages are absolutely correctly established, right? So let's first see what is already there in this model. We have the profit and loss statement for Maruti Suzuki for the last 5 years that has been fed in, and we have data from financial year 2011 to financial year 2015 in rupees crore. The company makes a revenue of 40,000 crore on a gross basis, on which they end up paying excise duty, and then what is left is net sales. Then they have some other operational income and other income. Now, what is other operational income? Other operational income is in the course of running the business, you could make some more gains, and these are some more incomes. These are kind of byproduct sales, or for example, services sales, spare part sales for Maruti. That will be other operating income. Other income, on the other hand, is let's say Maruti has some amount in their bank account, and the interest they get on that is other income. Total operating revenue is net sales plus other operating revenue, right? So total operating revenue is only the sum of this and this. Remember, other income is non-operating. Why is it non-operating in nature? Is because even if the company shuts down the business, you will generate interest on FDs, fixed deposits that the company has, for example. So this is non-operating in nature, right? Then we have their cost of sales or expenses, where we have raw material cost, purchases of stock in trade, change in inventories, employee benefit expenses, other expenses, and some meager small expense on vehicle or die for own use, which gives us the total operational expenses for the company, right? That's given to us. Then sales minus operational expenses should give us operating profit. So this is sales minus the operational expenses, and operating profit margin is nothing but EBITDA margin is nothing but your EBITDA divided by the sales number, right? Then we have depreciation expense that goes away, gives us earnings before interest and tax, interest cost for the company. Then we have earnings before tax, and then we have the tax rate which is applied on this. And finally, we have the profit after tax for the company. That's available in the profit and loss statement of this particular company. Let's look at the balance sheet. In the balance sheet, we have statements in the sense that we have shareholder funds, which include share capital that's constant post 2013. There's no share capital raised by the company, and reserves and surplus. If you remember, in reserves and surplus, we add any undistributed profits by the firm. So if the firm has not given any dividend, everything will get added to reserves and surplus. Total shareholder funds is the sum of share capital plus reserves and surplus, right? Then we have some non-current liabilities, which will be long-term liabilities. So you have long-term borrowings, you have some sort of deferred tax liabilities, you have other long-term liabilities and long-term provisions. Now, while we are not really required to understand what these are, in terms of the breakage of each one of them, we might want to kind of discuss things like, what is a long-term provision? So for example, an employee getting a salary, there could be a provision of gratuity into that salary or pension into that salary. And these are long-term provisions that the company makes. They will put it as an expense today, but it is not really paid out at this point of time, right? It will be paid out later. Then we have current liabilities. Again, the idea is not to really get too detailed in terms of what these line items are. You will learn all these as you go along during your studies in the MBA. But what is more important is that these data points will get used somewhere. So short-term borrowings is borrowings for the smaller period. Trade payables is what we are supposed to pay to the supplier. Other current liabilities could be, for example, a customer has given us an advance, and short-term provisions could be provisions you have put aside for things like bad debts or income tax payment, etc. that comes in, right? Then you go down and you look at non-current assets, which is tangible assets, plant, machinery, etc. Intangible assets, software, uh, brand value, etc. And capital work in progress, which is something that is going to be a long-term asset, like let's say a plant, but it is under construction today. So this is in effect under construction plants, for example, plant and machinery, correct? That's capital work in progress that we see. Non-current investments are long-term investments. Long-term loans and advances are money that the company has given to someone, for example, on lease. They have taken a factory on lease and they've paid a rental deposit there. There could be some other meager non-current assets. Current assets will include current investments. These are like short-term investments that the company has made in the bank. Then inventories, trade receivables, money that your customers are supposed to pay you, cash and bank balances, which is the actual cash amount in the bank that can be used immediately, short-term loans and advances that the company has made to others in terms of their overall loans given out somewhere, and there could be some other current assets as well. So, for example, you could have paid your supplier in advance, right? So those data points come in, and then you get the balanced balance sheet. The balanced data point gives you that the assets minus liabilities number is the same. And this is what will tell us whether the balance sheet is balanced. So when we do project the future numbers, it is important for us to understand where does this come from, right? And how does the balance sheet balance? This is the check number that we will have in our case. What is net working capital? Net working capital is the sum of all non-cash current assets. So the sum of non-cash current assets minus the current liabilities. Now, why are we taking non-cash current assets is at this point of time beyond the scope of this discussion. But just for understanding purpose, assume that net working capital calculation includes 4 data sets. If you look at this, this includes inventories, it includes trade receivables, it includes short-term loans and advances, and includes other current assets. It does not include current investments, which are in a form cash equivalent. This is a sort of cash equivalent for the firm. They can sell this and immediately make it into cash, and this is the cash. So these two are not included when you are making your calculation of non-cash current assets, correct? That's what your working capital calculation is. And once we have done this working capital calculation for every year, the change in net working capital is 1 year's value minus the previous year's value. So here C53 is FY12 working capital minus financial year 2011 working capital gives me the change in net working capital here, correct? So that's the data points that we have at this point of time. Cash flow statement is blank at this point of time because we need it only for subsequent years, right? The cash flow will define what gets linked to the balance sheet. The money that goes from the cash flow to the balance sheet is going to balance the balance sheet. So let's pick up the cash flow data now. And obviously, when we need to project data for their P&L and balance sheet, what is important is that there are some assumptions that would go into this business, right? So Maruti basically makes cars, and those cars sell at a certain price. So effectively, their revenue, which is nothing but their sales number, is going to be equal to the number of cars that they sell multiplied by price per car. Now this data is available for the previous years, so we can calculate the price per car data from the revenue and the number of cars data, correct? So let's look at this assumption sheet here that talks about what is their installed capacity, and what is their total car sales every year, right? Based on that, we get a sense of capacity utilization. And for now, just look at numbers till FY15, and then we will come to the later numbers, what is there. This helps us calculate the per unit price, per car price is available here. That's calculated by our initial formula where we took the revenue and we divided by the revenue by the number of cars, and that should give me the per car price, correct? At which they're selling the car. So that's how we calculated that. And we also calculated what is the growth rate in that number. Every year, what kind of increase is happening. And so first year they saw an 8% increase in car price. Second year they saw a 20% increase in car price, and then no increase in the subsequent years. Then what is the excise duty as a percentage of revenue? Around 9 to 10% of their total revenue, the price of the car, they have to pay as duty to the government. Then we just calculated what is the other operating income as a percentage of net revenue. That calculation gave us the gross revenue number for historical years, right? Now, next year onwards, Maruti tells that they have added capacity, which takes their total capacity to 15 lakh 10,000 cars. Now, our assumption is what is the capacity utilization they will do. So this number is what is our assumption. 85%, 85%, 85%. Argument's sake, we don't know about the correctness of the assumption as yet, and we are not even worried about that here, because our end goal at this point of time is not to correctly value the stock. Our end goal at this point of time is to only make the future projection such that everything is linked dynamically. Then as a later stage, when someone wants to, let's say, use a valuation exercise, create a valuation exercise out of this, then they can come and debate whether 85 is correct or not. So 85% of the capacity gives me the total number of cars produced and sold. That's 12,83,000. Assuming a 0% increase in the price per car, this is the price per car that we have taken. The multiplication of the price per car into the total sales of car, and I divide it by 10 raised to power 7 is because I have to convert it to crores. We get this value 53,397. That's the total gross revenue. From this, we have assumed that excise duty will remain the same. We have assumed that other operating income will also remain the same as a percentage of total net revenue, right? So we'll come to that as we go along. Then we have the entire cost structure that is available with us, where we just calculated each cost as a percentage of sales. And we find raw material cost was 66, purchase of stock in trade was 5.5% of sales. So what does it mean? It means that essentially if your sales were 100, then raw material cost was 66.5. Then purchase of stock in trade was 3.3, and then you have other expenses which was rupees 13.7. Those kind of calculations is what will come into the picture, which came in here, and we assumed for subsequent years that these numbers will remain the same. So there's no change in these numbers. And then we looked at effective tax rate that they are paying. How did we calculate effective tax rate? This was calculated as tax divided by earnings before tax. You're paying tax on the earnings before tax. So whatever is the tax rate will get identified based on that, correct? So that's the number that is here. Now, similarly, we have all the working capital data items that are available. These we have projected as a percentage of sales. So these here are in rupees crore, and then when you divide them by the number of the sales number every year, net sales number here, you get them as a percentage of sales. And all you have taken is an average of the last 3 years to kind of project it in subsequent years as well. That's all that you have done. What is the average percent as a percentage of sales, and you project it in subsequent years as well, right? Now, once we have all this data set with us, we can start populating the line items with what is available in the data sheet already, right? Some of the data points on the balance sheet will stay constant. Some of the data sheets will change based on the data that we have, right? So what is the gross revenue from operation? And this portion here is going to be the projection space, right? FY16 onwards, financial year 2016 onwards, we're projecting everything. What is the gross revenue? We had calculated the gross revenue here, 53,397, right? Excise duty is 53,397 multiplied by 9.6%. Correct? For that year, we have assumed a 9.6% number. That's my excise duty, which gives me the net sales, which is gross sales minus excise duty, right? I will select this entire thing, format it once. Then other operating revenue is net sales multiplied by 2.8%. That's the assumption we've taken. 2.8% as percentage of net revenue. That's the other operating income. That's here. Other income, let's keep constant. Let's keep the other income same as last year. Net operating revenue would be net sales plus other operating income, right? So that gives us the data. That's the calculation for the total operating revenue. Now, essentially cost of material calculation is here 66% multiplied by the revenue for that year, net revenue for that year, and we can freeze this here, and I can then drag it down. And this change in inventory, we have already included this in cost of material here. When we calculated this, it already included the change in inventory part as well, so we don't need to take it separately. What is employee benefit expense? That is assumptions 3.3% multiplied by the revenue for this year, net revenue, and again we freeze the net revenue. And similarly, I drag this down to get this data point as well. The sum of these four is going to give me the total expenses. Remember, we have not assumed any vehicle for own, dyes for own use, because that's a very small number any which ways. And we have not really incorporated change in inventories of finished goods and work in progress, because we have assumed that to be a part of raw materials itself in our calculations, right? So all this is included. That gives us a total expense for the year of 42,959. Correct? Now, what does that tell us about our numbers here? I can do a control C and a control V, and it gives us the calculations here. Depreciation and amortization expense. At this point of time, we'll assume it to be the same as last year, right? No change in depreciation and amortization. That is assumed to be the same as last year. And then we kind of get to the calculation of EBIT. So control C, control V. Again, finance cost, let's assume to be the same as last year, because we are not assuming any change in production. So there is no point assuming any kind of change in terms of the numbers that are happening on the finance cost. Earnings before tax will come in here. Taxes are earnings before tax multiplied by, on the assumption sheet, 23.8%, right? We can assume this to be 25% as well. And then the final profit number again is a formula which gets linked to 3677 crore, right? This is the projection of the P&L statement for the first year, and the data that we have plugged in is basically largely similar to what last year data was in a lot of the cases, like depreciation, like interest, and percentage of sales in certain areas. Revenue we have projected based on a calculation of what is the utilization rate, how many cars are being sold. Based on that, and what is the revenue per car. Based on that, we calculated what is going to be the revenue number. That gives us our calculation for the P&L statement for that particular year. If we want, we can try and do a control C, and because our calculations are available for subsequent years as well, we can do control V and control V, and you'll note that all the numbers will appear exactly the same. There is no difference because we have assumed the same capacity utilization. So same number of cars will get sold at the same price they will get sold. Costs are kind of the same, so margins become the same as well. And then when you look at further numbers, all the other numbers are the same as last year's. So it kind of gives you the same profitability number for now. This is projected, but we have not changed it. We can change these numbers if we want generally to play around with. We can put this as 90% and put this as 90%, the capacity utilization, and you will see the profit number increases. The profit number increases because the sales number increases, Everything else kind of remains the same, and that change essentially brings about a big change in terms of what is the sales of the company that is coming through. Correct? That is the value that comes through and gives us the data point. There is one small error that is happening here, which is when we link this data set that is linked to G8 $G $8, right? And here also it is $G $8. It should be linked to the cell here. So in our freezing, we had made a mistake. The freezing needs to be G $8 so that when we drag it down, that doesn't change the data set. Here also it should be G $8. We don't have to freeze the column. We only have to freeze the row, and I can drag it on this side, and you automatically see that now the operating margin remains the same because we have assumed the same cost structure for the firm. Profitability changes a little bit based on what assumptions we have made and changed here. We can play around with the numbers a little bit here or there in the yellow cells to get a sense of what these assumption numbers are and how would that change the profitability of a company. That finishes our calculation on the P&L statement projections. We will continue with the balance sheet projections in the next section.